Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. G'day, Raymond. How you going, mate?
Yeah, pretty good. It's pretty hot today in Sydney. Got the aircon on, so yeah. How about yourself?
Nice. Yeah, it's not as hot down here. I think I do have the cooling on, but it's I guess that's just luxury when it's not that hot and you can turn it on. But yeah, mate, it's actually quite nice in Melbourne, so I'm very happy with that. At least I think my happiness is up at least 30% as a result. This is actually the first podcast you and I have done together. So you've interviewed a few people for the Investors Podcast. I've interviewed a few people, but we haven't actually sat down and done this together, which is a bit of fun. I thought maybe a way that we could start this conversation, we're going to be talking about culture, and we're going to be looking at some ASX companies. We've got some data we're going to crunch, and we can even share our screen for those people that are watching on YouTube. However, before we get into that, and we kind of name and shame the best and worst, do you have a joke, an investing joke for myself and listeners?
Not really at the moment, but I heard you're really good with jokes. You're the jokester of the team, so I'll let you handle that one. So
okay. Yeah. So okay. So here's my joke for today's episode, and see if you probably know the answer to this one.
Yeah.
Why is Ireland a good investment? As in the place. Why is Ireland a good investment?
I have no idea. I wouldn't mind being on Ireland right now. Well, it feels like I am because it's pretty hot at the moment.
True. Well, I tell you why Ireland is a good investment. It's because its capital is Dublin, as in Dublin. That's it. That's my joke. Okay. So enough of the bad jokes. I probably should have tested that one on you before we came on air. But today,
it's not bad. It's not bad. It's not bad.
It's not bad. I'm practicing my dad jokes. If you have a better joke for us, be sure to find us on Twitter. I believe your handle on Twitter, mate, is _RJang. Is that correct?
RJang _.
RJang _. Cool.
Other way around.
Other way around. And mine is at Owen Rask. Tell us your jokes on Twitter, your investing jokes on Twitter. We'd love to hear from you. So, mate, we're talking about culture today. You have a very different background professionally to me. You've come from like a government and corporate background, whereas I come from kind of like a startup background, I guess. But we both recognize the importance of culture. One of the things that I've realized in doing all of these interviews with investors, but also doing my own investing, is that culture is so important when it comes to investing, because companies are effectively just tribes of people that come together for a common mission or a common goal. And as investors, we kind of lose sight of that very easily because we can't quantify it. We're going to introduce listeners today to some techniques and ways of, I guess, understanding the culture of a business. It's not a perfect way to do it, but it's a good way to do it. But maybe, mate, we could just jump off with like, why do you think culture is important in investing or in companies?
Yeah, 100% agree with you on the importance of people and the importance of culture, because it's often the hardest thing to quantify. It's almost impossible to put a number on it. But for me personally, having worked through different teams and experiencing different cultures, when I first started working in an accounting firm, I think culture is really important in a smaller team, because you really need to communicate really well and rely on each other. But the same goes for like playing in sports teams. It's a classic analogy. I mean, you see the most successful teams in the world where they have really good, strong cultures. And I think it comes down to the individuals as well. The individuals within the team shape the culture and it shapes the direction. And when that goes pear-shaped, then it can have devastating consequences.
Mm. Yeah, it's the sporting analogy is a really good one. I think there are many, I guess, analogies that come from sport. We've heard in the past about like building an investment portfolio is like, having a great sporting team. You put the best players on the field at any one time. And I think that resonates a lot with me because my approach to at least putting the team together at Rask, even in that very phrase, I use the word team. I don't ever really think of anyone as colleagues, and we don't really have, I guess, we're still very early in our journey. We haven't got it right, but we don't really have like a chain of command. We don't have a hierarchy. And more we're seeing companies start with a much flatter organizational structure, which I think is an important thing too.
Yeah, I think being transparent is really important, and having a smaller team, communication is like really important. And I think one of the key reasons that drew me to joining Rask was I could access a lot of your interviews and you were very transparent on social media. So it was pretty much an insight into the culture at Rask.
Yeah, I interviewed a guy called Lawrence Lamb on the show before. He's a young portfolio manager, and he only invests in founder-led companies or family-led companies. And he basically, talked about that idea that the first place out of university or the first place out of school, that is kind of the culture and the kind of the work philosophy that you have and you take with you throughout your career. And mine was starting at the Motley Fool. When I started at the Motley Fool, there was I could count them, the number of people in the team. There was Bruce Jackson, who's basically, I think of him as the founder of the Motley Fool Australia, who's since retired just recently. Scott Phillips, who was a freelance writer and then became obviously chief investment officer and general manager there for a while. There's Ryan Newman, who's one of my closest friends, Regan Pearson, Tim. Both of those guys were writers like Ryan and I. And then there was Mike King and Robin as well. So there was literally like 6 or 7 of us. And what I realized is that we were able to build a super, super, super successful business as a very small team. And it was that kind of transparency within the team, even though we were freelancers or contractors and they were full-timers and whatever. That transparency went right the way up to David and Tom Gardner, the CEOs of the Motley Fool. And took that with me into building Rask. So as you know now, we've never, if anyone was to come to me inside of our business and say, hey, how much profit or loss did we make this month? Or, how much cash do we have in the bank? I'd tell them. It's never fazed me, that kind of transparency, because I think you're going to say this, but the more kind of, I guess, layers there are, the less transparent things become and the less well-oiled they become.
Yeah, that's right. I think having moved from a small, not really a small, but like a medium-sized accounting firm to a much larger organization being at ASIC, there was definitely a lot more layers of management and there's more red tape. So things don't move as quickly as, compared to a smaller team. I mean, at Rask, we can try a lot of things and we fail fast, but we can break things. We try new things and find out what works out. And that was similar at, William Buck, where employees were given the opportunity to, work on certain projects that they wanted to. And as long as you tried your best and you learned from your mistakes, I think that was a key lesson. But I think, it's harder to move fast in a larger organization.
Yeah, it is. And that's where, I guess we talk a lot about incentives as investors. We talk about the CEOs and we talk about the kind of the CFOs, the board of directors, and not many people think too far down the organization, even though that's where the real work is done. The people at the coalface, if it's a retail business, they're the people that actually get the work done, not the CEO. And yet we judge the CEO because we expect them to have influence over an organization. But the reality is we need to understand more than just the CEO as investors. We want to understand why people get up and go to work. I once had this carpet layer come out from Bunnings Warehouse. He came out to our house and My mum was actually talking to him, and she asked him, said, "Hey, do you like working at Bunnings Warehouse?" And he said that the worst day at Bunnings is the best day anywhere else. And it was a really interesting quote. He just kind of just reeled it off straight away as if it was like a mantra that him and the team lived by. And that always struck me as something that was really interesting, because when you do go into Bunnings, you don't really find that. Well, I mean, you get them everywhere, but you don't really find too many grumpy people, too many people that are not willing to help. And so I think that's kind of an example of how culture permeates an organization and feeds back to customers. Another anecdote that I'll bring up is just the one from, and this is relevant to what we're going to talk about today, and when we use the ASX examples. One of the ones was from Sam Huppert, the ProMedica CEO and co-founder. When in an interview on the Australian Investors podcast, he said, you want to hire great people, not a lot of people. And I think more and more these days, I'm seeing that, better organizations, the best organizations, are able to get more done with fewer people, because we now have tools available to us. We have endless amounts of cloud computing. We have various tools online, like organizational tools, content management tools. It's easier to start a business now, all of these things. So I think that's another thing that really rings true with a lot of great companies early on, is hiring really good people and going from there. But mate, I thought maybe we could talk about how to get some type of insight into the culture of a company. Based on the research you've done so far on companies, or even just the tools that we use at Rask, like how do we do it? How do you do it? How do you get a pulse check or a read on what companies are like from the inside?
I think there are a number of tools available online. I think the web has so much information available where you can try and draw inferences from employees, current employees or former employees who are submitting employee reviews. You can get a sense of how engaged employees are by looking at their LinkedIn feed, or even just basically trying to talk to former employees who used to work at that firm, and they may have moved to a competitor, and that might provide you even better insights, because that gives you a comparison between the culture at the firm, where they left and then where they're at now. So it gives you that competitive analysis at the same time.
Sorry, just on that, you because you did a lot of the coverage or all of the research of Catapult, the sports technology business, and is it Will Lopez? Will Lopes?
Yeah.
He came across to Catapult from Audible, I think, and he brought a lot of people with him, right?
Yeah, exactly. A lot of top level management had moved across over to Catapult, and that's mainly because they had a really good working relationship with Will Lopes. And I think that probably speaks to his character and his reputation.
Yeah, another company that we've spoken about a lot, which is another smaller company. It's a company called EnviroSuite, which trades on the ASX ticker symbol EVS, which has got a very checkered history in terms of acquisitions and the like. But Jason Cooper, who is the new CEO, I've spoken to him, and when going into the conversation, as an analyst going into the conversation with the CEO, you kind of have your guard up a bit because you want to kind of interview them and you want to understand more about them. But coming away, I was so impressed with the way he communicates and the way he takes feedback. And then it was obvious to me just why so many people followed him across to EnviroSuite. And I think that's a sign of a really competent leader and a really, I guess maybe talented leader in a team, because if we are saying here on this podcast that culture is what drives companies, if you need good people to do that. And so the hardest thing to do is find good people if you talk to any business leader. So if they can bring people across, they're going to have their foot in the door. So mate, let's talk about using these online tools. For those people that don't know, they can use Glassdoor, which is very, very handy for HR reviews, for employee reviews, for US companies. You can use like Indeed, which is the kind of the third place player. And then you've got Seek. A lot of people don't know that here in Australia, you can use the Seek website to look at employees' reviews and HR reviews. So those are three really powerful things. Are there any others? Would you add something, say, like LinkedIn to that list?
LinkedIn is pretty useful if you're trying to track very important employees within an organization. So when I say important, I mean the employees, like say at a software company, it could be the software engineers who are behind developing the key software systems and the products. And it really depends on the industry as well. So if you're talking about retail and more consumer facing roles, you want really top level store managers who are really driving employees on the ground. But I think another tool that we probably didn't touch upon was just reading the transcripts, so investor presentations and the statements to get an understanding of what actions has leadership taken and what have they said. Have they, completed what they promised to do? And I think, actions speak louder than words. And I think great leaders always set the culture. So,
yeah, I agree. I think that the leadership team is most important because they're, at the end of the day, it's the executive level and the board of directors who are responsible to shareholders, and we're shareholders from the outside. Whereas, people in the inside there, they might be the ones that do the work, but they're getting inspired and led by someone else. So that's why, when a company goes poorly and performs poorly, it's the CEO and the board of directors that get the chop, because those are the ones that are accountable to shareholders, and shareholders see a falling share price or some sort of scandal. So, the buck has to stop somewhere. So it stops at the top. But what we're trying to do today is look a little bit deeper than that, to go a bit further down, because, we've heard of things like out of Silicon Valley, like beanbags and free fruit and yoga sessions and all these types of things, which obviously is a form of culture, but it's obviously not the only form of culture. I remember looking at, I'll give you an example of a company where culture is important to consider, but it might not be what you think it is. I remember talking to a travel agent about their experience working at Flight Centre, and they said, "Oh, you'd never work for Flight Centre. It's all about sales and it's all about commissions. That's all they think about, right?" But then if you think about Flight Centre's business model, that's exactly what it is. It's a sales role. You're selling people travel. And so that's what you can expect from a company like that. Now, that might not suit everyone, and I'm fully aware of that, but that is the culture that's required to make that business a success. At least that's in its current form. That's what's required. But if you took that same culture and you applied that to, say, Google, you probably wouldn't retain a lot of staff, because it's a different culture set. You need engineers and probably people more on that side of things, rather than, say, on the sales side of things. So it's really important to understand culture for what it is in context. Mate,
that's a great point.
Yeah, I might throw it over to you to run through. So maybe I'll share my screen for those people that are watching along. I'll share my screen, and maybe just for those listeners that aren't watching, you can just explain some of the companies that, from our data, we've got about 130 companies here that we've looked at on the ASX, and we've looked at the HR score. So these are kind of like the most popular companies. We've got the banks in here. We've got a bunch of the big tech companies here in Australia, the industrials, etc. Maybe you can explain some of the companies that did pretty poorly from a HR review perspective, and maybe dive into why they performed poorly from the HR scores perspective.
Yeah, so the first one you've got there is Nuix. And Nuix has been going through a lot of pain last few years. It's just been ongoing scandals and negative headlines, mainly because the former CFO, he had potentially or allegedly provided misleading forecasts as part of the prospectus. And also there was allegations of potential insider trading with, I think, his brother. And I think, and even looking at the Glassdoor reviews, dating pre the IPO, which the IPO occurred, I think, in 2020. But Glassdoor reviews, a lot of the older ones, show that people weren't happy with management. And there were a lot of issues, underlying issues, with how management weren't receptive of feedback. it was either their way or the highway. So I think that's a very, I guess, bad way for managers to approach things, because you can't expect an organization to move forward if managers aren't willing to listen to new ideas or listen to feedback from their direct employees. So yeah, that's the first one. Do you have any other thoughts about Nuix?
Yeah, well, I guess it's very easy to become disenfranchised, right? With if your company, if you're let's say you work in, I don't know, let's just use the tech team, for example, at Nuix, and you're developing this software that helps run analytics and stuff. If your industry is pretty in demand, why would you stay there if you're copying all this, headline crap? Why wouldn't you just go somewhere else? And so, and then the managers of those teams become stressed because they're losing good people, or they have to deal with, spot fires everywhere. And so all of a sudden it's just this constant feedback loop. But what's really interesting, we'll get to what's really interesting. So when we look at these scores, so how are we getting the scores? Just to be very clear, we are getting the scores that employees give voluntarily to the websites like Seek, Glassdoor, Indeed, etc. But what we're Raymond and I are not saying that this is the only thing that you should look at. You'll notice in Raymond's commentary there when he talked about Nuix, he's actually talking about looking at the reviews themselves. So not just taking the number, but we're taking the number to just identify these companies to see if we can find something interesting. So you've got to look a little bit beneath the surface. And you've also got to be mindful that sometimes there simply aren't that many reviews on these companies. So yeah, I think, it's pretty easy to see how Nuix got to where it is in terms of, having such, I guess, poor reviews. What about some other companies? What about EML Payments? That's another payments company. I think I own shares in that company. So what happened with EML?
Yes, for full disclosure, I also own shares in EML. So EML was hit with regulatory concerns, mainly because of its acquisition of prepaid financial services, which was the payments business that they acquired, which was based in Ireland. And the regulatory authorities in Ireland had issues with the certain things that they assessed in terms of anti-money laundering. So yeah, on that respect, it's one of the key risks of payments businesses because it's heavily regulated. So you want an organization who's really on top of this and also really moving forward with trying to identify the issues early. So I guess even though it was a different business, it wasn't the original business, like in terms of the management teams, it would have been prudent to try and get across all the details of the company that they were acquiring. So I'm not saying that's the key reason why for that kind of result, but I think the employee reviews on Glassdoor can provide an indication of the attitude towards risk management, perhaps.
Yeah, and one thing that's really interesting, it's just kind of like another. So this is like if we talk about being an analyst and having like the mosaic theory, which is like piecing together what actually goes on inside a business, piecing together what's going on inside the industry. This is just one piece that goes into the mosaic. So obviously, if employees are saying things like, "Oh, we're not sure about the compliance and the oversight," and all of a sudden the company comes out with some compliance concerns, well, you've obviously got to start questioning things. Like that's like another piece of the mosaic. You're like, okay, well, this is piecing some things together for me. One of the things to be mindful with all of these companies, like you said, is EML Payments is the Australian company. If you're trying to find reviews and understand what's going on from a HR perspective, you might have to go into the divisions because, EML Payments buying PFS Financial Services out of Ireland, you would have to find what PFS's employee reviews were like. Not necessarily EMLs. And so that's, for example, a company like Pro Medicus, which is here in Australia, its primary business is actually Visage. It's called Visage 7. And that's Visage imaging is actually, in the United States. So you've got to go to the Visage imaging page, not necessarily to Pro Medicus because it's so small. So what about this company? This is a company that we've known for years, which is Nearmap, trades under the ticker symbol NEA on the ASX, gets a score of 3.4 out of 5, and only 60% of staff said that they would refer a friend to work here.
Yeah, I think you were saying that they had a period where a lot of the key technical staff at Nearmap had actually moved to another company. Is that right?
Yeah, that's right. So so maybe I can field this one. So what actually happened was, not everyone, but some of the staff actually left. There was a competitor that started up to Nearmap, which I'm led to believe, was influenced by a lot of former employees. We've seen a company like Pointera start up, which is obviously similar business but does more data engineering. That had some people from Nearmap involved in it. And then there are other companies like, I believe it's Spookfish. And then Eagleview in the United States, which is the big competitor. There are a few issues there. All of these things combine. And Nearmap shares are down 50% over the past year. I don't necessarily think that's because of their culture necessarily, but I think in the early days, those were some of the things that I realized. Even as I held shares, I was aware that maybe there were some culture issues underneath the surface. So that's Nearmap. Actually, over 3 years, the shares are actually up 45%. So, down 45%. Over 5 years, they're up 154%. So another company which people will know really well is AMP. It gets a score out of 5 of 3.3, and only 51% of people would say that they would recommend a friend works at AMP. Are you surprised by this one?
Definitely not. I think most people would be aware that AMP was involved they were scrutinised in the Royal Commission. So there were a number of failings. I think it's a really long list of failures. Firstly, they charged dead people for administration fees. They had really aggressive sales tactics with their insurance arm. Thirdly, I think they were charging fees for no service, I'm pretty sure. The list does go on. And there was a misalignment with incentives because the financial advisors who were providing advice were really incentivized to increase sales.
Yeah, and that's been the whole fallout of the Royal Commission, hasn't it? It's not just AMP, but even if it's, I guess, the perception as well. If you work for one of these organizations, it's the perception of what they stand for. And I know plenty of great financial advisors that have worked for AMP, but some of them, probably were really chasing that carrot in terms of, I'm going to get a commission if I recommend this product to my client, even though it may not be necessarily what I'm seeking. That's the best in their best interests. So those are some of the I guess poorer performers. There were some other interesting companies here. So what we've done is we've looked at the companies, we've looked at their overall rating, so what employees give them out of 5, and then we've also looked at whether they would recommend referring to a friend, like saying, "Hey, come and work here. It's a great place." And then what we've done is we've just done a very crude thing and looked at the 5-year and 3-year returns from the companies. So there are companies in here which I should draw attention to. So a company like Pointera, which I did say a minute ago was influenced by some people from Nearmap. Now this company here has really no Glassdoor or Seek reviews because it's actually only got one, because the companies are simply not big enough and there aren't enough employees. I think there's only about 35 employees in total around the world. And that's basically doubled in the past year. So no one's really given them a review. Yet the shares are up. But then we've got companies that are bigger companies that have done really well, that do have good culture ratings. So companies like Xero gets a 3.9 out of 5. So 70% of people would recommend working there to a friend. 486% return over the past 5 years. CEO approval rating is 97%. Obviously, Xero is one of those companies people want to work for, right? Like it's from a tech perspective, from a financial perspective, people like it. So we would expect to see strong results like this.
Yeah, I'll also note that I think when Xero first started, it was making big changes. It was essentially the innovator in the accounting cloud space. So as an employee, as a software engineer, you want to be working on the most exciting projects. So yeah.
Yeah, and that's the thing, right? You actually bring up a really interesting point there, and this comes from another Kiwi company that I own shares in. So I own shares in Xero and in Pushpay, which I'm about to mention. Pushpay was run by a guy called Chris Heaslip and Elliot Crowther. They co-founded the business. And in an interview many years ago, Chris actually said, there will come a time when I'm not the right person to run this company. And as someone who's worked in startups and worked in, early stage businesses, I can attest to not wanting to work in larger organizations because I like the kind of, at least in this stage of my life, I like the many hats kind of a bit more like the sprinting kind of culture. And I think for some people, Xero would have been a great place to work when it was, 100 employees. But now that it's got, many hundreds of employees, it's probably not the right place for them. Or they probably think this is, my time here is done. Maybe, that's just a generalization. But I think that's also important to understand too. People like being in growth companies. And what we find is that as companies go through that, they cross the chasm and they hit that inflection point. Typically, like they're really happy, they're really engaged. But then as soon as the growth starts to fall away, some employees become disenfranchised and they leave, and that's okay too. The second company on the list here is WiseTech. Obviously, it's achieved pretty impressive growth of 784%, just share price returns only over the past 5 years. Gets a SEEK rating of 4.1 and a recommended rating for people to work here of 78%. The next company that I'll bring up is Zip, which is the buy now, pay later business. It actually got a better rating than Afterpay. So Zip got a rating out of 5 of 4.6, and 89% of people would recommend that their friends work there. So really,
that's very interesting.
Yeah, really high scores there. So
I wonder if that's because Afterpay had that first mover advantage, and then Zip came on board and tried to, really focus on building a really attractive culture to try and get talent across to the team.
Yeah, I don't know. It's just a really interesting one. I think they both scored highly. So, but now obviously Afterpay is part of Square, so it's part of a bigger beast, but still it's the same business, large part. What was really interesting here is people, if they're watching this, they'll see that Appen, which trades under the ticker symbol APX on the ASX, has a really low rating of 3.2 out of 5, and only 54% of employees would say that they would recommend this one. What's really interesting about Appen, and we're talking about this off air, is Appen, even though it's this kind of sexy machine learning tech company, it actually is, it can get some, it gets a lot of reviews from employees who may have been contractors, so not necessarily employees, because the nature of its business is it deals with like outsourcing and kind of data labeling for engineering firms. Like it does a lot of the third party work for the big tech companies. So it's important that you scratch beneath the surface and don't just take all of these at face value. There were some other really interesting companies in here. I saw one which I'm gonna call out is a company called City Chic Collective, which is the fashion retail business. Shares are up 726% over the past 5 years, and it's got a lot of reviews, but it's actually the ratings that it gets from a HR perspective are actually very, very low. And I haven't actually discovered the true reason why, but only 2.6 out of 5. And then only 28% of employers would refer a friend here. Maybe at risk of this going on for too long, because I know we've got to get to the banks and some big tech. The one final company that I'll call out, and probably this is maybe a flaw in the data, is ARB Corp, the really strong performing Australian bull bars and 4x4 accessories business. Only gets a 2.2 out of 5 according to Glassdoor, and a 41% of employees say that they would recommend a friend work here. However, it's only based on 9 reviews, so it's not a sufficient sample size. But I just thought that was interesting. If we just look at the reviews really quickly here, I don't know. I feel like maybe there are certain instances where, I guess you don't need to take it at face value. Like this is one piece of evidence that you would disregard in your attempt to create a mosaic? I find when I'm looking at this stuff, mate, I find that I look at the advice to management part probably the most. I don't know when you're reading through these, what you look at.
I think I tend to go through all of them, and I think it's important for people to understand that every single review isn't going to be accurate. And I think you really need to understand which ones are really just vanilla type of reviews where they're just talking, they're just providing a really generalistic opinion. And they might, I'm not saying that they're fake reviews, but there's every opportunity that they could be. So it's always important to really read it properly and see if they're saying something different and saying something quite unique to the organization, because I think those reviews tend to be probably more accurate.
Yeah, and I think that's a really good point. I've tried, to be honest, I try to massage the reviews that I read a bit. So I tend to look at the twos, the threes, and the fours rather than the fives and the ones, because the fives might just say, if there's only a few fives, they might just be the really positive ones that the people high up in the business give, and the ones might be people that were actually fired for a reason and are just really disenfranchised with the company. But the twos, the threes, and the fours are the ones that are a bit more like, they're not giving ones, so they're not completely put off. They're not giving fives, so they're not parading around saying it's the greatest place to work, even if they don't mean it. And then what I try and do is I try and find commonalities between the reviews. So if one is saying, there's the compensation's too low, another one's saying the compensation's too low, the third one's saying compensation's too low, well, then maybe they need to be paid more. I think one thing that you might, like, I'm just reading over these ARB Corp reviews quickly here. ARB has company-owned stores, but it's also got the head office business, which makes the decisions, and it's got the manufacturing floor as well. So you don't know where these reviews are coming from necessarily. So you've got to, I guess, take some of them with a pinch of salt. What's really interesting, I know we're kind of going on a bit here, but what was really interesting to me is looking at the big banks, mate. So the ratings for the big banks have improved substantially since the Royal Commission. One of the things you can do if you're looking for employee reviews is when you go onto, say, the Glassdoor website for CommBank, you can click on the score and you can see the trend in the score over time. And you can see here, CommBank has been pretty stable over time. But many of the other ratings, it's actually improved upon. So like culture and values, etc. And I've seen that since the Royal Commission, a lot of the banks have improved. So that's pretty impressive. It hasn't really stopped their share prices going down. The only one with a positive share price over 5 years is Macquarie. Obviously not a retail bank, more of an investment bank. So yeah.
I think that's a good reminder of how much time and resources it requires to rectify a lot of issues that a company has to go through a Royal Commission. Sometimes they spend so much time and money on improving one aspect, being culture and governance, and that detracts resources and time away from their core businesses.
Yeah, that it does too, doesn't it? And that's when heads will roll as well, in terms of management teams will be fired and so on and so forth. But then also employees and customers will leave too, because why would you stand for that type of thing happening at your bank or at the business that you reward with your business? So yeah, it's really interesting. I think one final thing we wanted to call out here was just that some of these tech companies, like here we've got Canberra in front of us, you can see it gets a 4.7 out of 5, so one of the best ratings you can get. 91% of people would recommend to a friend. We can see with a lot of the big tech companies, even though they're big, they employ a lot of people, they're still getting fantastic reviews, right?
And one thing I'll say about these companies operate in a space which is kind of sexy when you think about it. Like if you want to work for a company, these companies kind of make really cool things, right? I mean, at Rask, we have like nearly every product I own now is Apple. We even use Canva. So Canva is a very fun tool to make designs. And and it provides people with some sort of emotion, like whether that be happiness or fulfillment. So
Yeah, yeah. Atlassian, one of the companies we don't use here at Rask, probably should. Um, Fantastic ratings again, 4.6 out of 5. 92% of people recommend to a friend. And all this once again, I can stop sharing my screen now. All of this once again, mate, just reminds people that if you want to attract the best talent, you have to have a great culture, right? And so if you're investing in this way, this is a fantastic, I guess, reminder that you should focus on the culture aspect as well. So I think we've covered a lot of ground, but this is one of the things that is harder to quantify, but it requires, it is such an important thing to go out and to research, because what we find is, as investors for the long term, basically you need to figure out why a company's profit or a company's sales in years 2, 3, 4, and 5 is going to be more than it is today. And that sounds very simple to say, but if there's already a PE ratio, if there's already a certain amount of sales, everyone else already knows that. It's on you as the investor to discover why that might be improving and what drives those sales higher. What's getting the big deals done at Pro Medicus? Why do people go into an Apple store and always spend more than they think? Why do people manage a Coles supermarket instead of a Woolworths supermarket? These are the questions that analysts have to discover, and we've just introduced you to how you can do that. So just a reminder for people, you can use Glassdoor, you can use Indeed, you can use Seek, but you've got to scratch below the surface. It's our sample size of 100 companies is probably not enough to really understand why things are happening and run that kind of correlation. But if you want access to the data, just send us a message on Twitter or wherever you get your social media. Try and find Raymond or I, and we'll be able to set you up with access to the data that we've put together. But mate, this was a bit of fun for the podcast. There's a bit of a late decision by us to pull this one together for tomorrow. We were going to do a reporting season special, but things got in the way. This is okay. We can talk about this. It's a bit of fun, and we get to do it together.
Yeah, it was a pleasure. I think I really enjoyed a different chat. It wasn't just about investing, but I think something, as you said, it's really important part of the investing process. So yeah, it was really good to chat, Owen.
Yeah, thanks, mate. We do have this, just for listeners' sake, we do have culture and HR actually built into our investing checklist at Rask, for the very reason that not a lot of analysts actually look at it properly. And we think it's actually a sustainable source of insights and edge as analysts. So if you can discover companies with great cultures earlier on, with high, revenue per employee, gross profit per employee, if you do these metrics, you might come up with some really interesting things and discover a lot more about the business. So Raymond Jang, @Jang_ on Twitter. You can find him there. I'm at Owen Rask. So mate, always a pleasure. Thanks for joining me.
Thanks, Owen.